Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio since 1977. What I would like to talk about in this short video is how you can use the business cycle to set up your investment strategy. What I mean by that? Okay, just listen up. Well, the question you have is why we need an investment strategy. Well, because our knowledge of the future is not perfect. So we don't know, we roughly know what's going to happen, but we have to play the future. And the future is a matter of probabilities. How do we know how comfortable we are with what we see? And then the other thing, the reason we need a strategy is because we need to manage risk and make returns more predictable. That's the basic two things. We need to deal with the future, which is not perfect, and on the other hand, we want to manage our returns and make them more predictable. Let's see how. The basic result of this strategic decisions is really, when you manage your portfolio, is what to buy or what to sell, how much you want to buy, and then when you're going to buy. So what you want to buy and sell, what kind of sectors, what kind of stocks, what kind of bonds, then how much of it you want to buy at any point in time, and then when. This is really your basic strategic decisions at any point in time. I'm going to keep it very simple, but this is the business cycle. This is the growth of the economy. This is the average growth of the economy. I wrote a book. If you go to my blog, I have many articles written about the subject. That basically there are two basic periods. Periods 2 and 3, when the economy grows more rapidly and faster than the average growth, and then periods where the economy grows much slower than the average growth period. During this period, you have interest rates rising, you have commodities rising, and you have the Fed tightening. During this period, you have commodities peaking and then declining. You have interest rates peaking and then declining. You have the yield curve is steepening. And then here you start lower again. Interest rates bottom out and they start rising, and so on. And the cycle starts all over again, over and over again. The stock sectors and the asset classes that do well in periods 2 and 3 are totally different from those who do well in phases 4 and 1. This is something I think I'm totally convinced about it. That's how I manage my money, and those are my clients. Let's see what by the way, I have other videos dealing especially what are the sectors doing well here and do well here. Just you have to go to YouTube or to my blog to find out. Investment strategy is a very dynamic process, and it depends on your understanding of where we are in the various phases of the business cycle. So that's why, let me repeat again, what happens when you move from phase 1 to phase 2. You're beginning to see the Fed tightening. The yield curve is steep, but slowly and gradually in phase 2 start flattening. Commodities, as the economy improves, start rising again. Of course, rising commodities are associated with higher bond yields and therefore lower bond prices. Short-term interest rates rise, financial risk rises, and then, of course, you have rising inflation. Instead, when you go from phase 3 to phase 4, the slowdown phase, you're beginning to see the Fed is worrying about what's happening in the yield curve. You can reflect it on a yield curve that is steepening slowly and gradually steepening. Commodities start declining because the economy is weak. There is low demand for commodities. please do forget about China for a moment. Yields, bond yields go down, decline, and therefore bond prices rise. Short-term interest rates decline because of lack of demand from business for short-term loans, helped by the Fed. Financial risk declines because the Fed makes sure that there is no lower risk for the markets. And then, of course, inflation declines also because the economy is weakening and everything, prices slow down. One of my preferred indicators to see what the economy does and what the business cycle does is orders, and this is as of October, November 2012. But you can see the business cycle here. The economy expands. This is when commodities rise, are very strong. You are now here in phase 2, very strong economy. Then at some point, inflation starts rising. The economy and the Fed start tightening. The economy starts slowing down. Commodities peak, interest rates decline, bonds are very strong, and then this business cycle starts all over again, and then here again on the downside. So this is a very important chart to see how the business cycle goes up or down. We'll have dealt and we'll deal in other videos what are the assets that do well in this period and the assets that do well in this rising here and here in the rising phase of the business cycle. Now, the importance of the investment strategy, why do I talk about this thing? Because the investment strategy changes. Here you become more aggressive, the economy is strong, commodities are strong, so commodity sensitive stocks. But then when you see that the economy is going to start slowing down, you get away from commodity sensitive because you know commodities are going to peak. Therefore, you move more in the kind of stocks and sectors that do well when the economy slows down, bonds being one of them. And then you start all over again. So it's a constant transition going from aggressive, commodity sensitive, less commodity sensitive. Here you don't go in bonds, here you are more in bonds. Why do you do all this work? Well, because during periods like this, the market goes down 40% or 30, 40% in 1 month. So what you're trying to reduce is this kind of drawdowns. So by moving in conservative in stocks, in sectors like bonds and other stocks that I will talk about later in different videos, you are minimizing the volatility of your portfolio and making your returns more predictable. This is the whole reason for studying this kind of issues. I found in several decades and many years of practical work with these issues is that a practical way to manage risk is to focus on the mix bond equities during a business cycle. You reduce your bond and increase your equities when the business cycle transitions from phase 1 to phase 2. You increase bonds and decrease equities when the business cycle transitions from phase 3 to phase 4. For instance, beginning in 2011, when the economy, 2011 in around May, when the economy started to slow down, if you look at the previous slides, that would have been a great point to move away from commodity sensitive stocks slowly and steadily. Everything is slow and steadily, and move more into bonds in defensive, what they're called defensive stocks, but stocks that do well when the economy weakens. But the bottom line here is what I think should be interesting to you, that the business cycles, short-term interest rates, bond prices, commodities, stock sectors, risk are all tied together, and they're all connected together to manage the risk of your portfolio, that is to make your returns of your portfolio more predictable. Thank you very much for reviewing this video, and I sincerely hope that I help you I gave you some ideas on how to develop investment strategies to make your portfolio or the returns of your portfolio more predictable and minimize risk. Again, thank you very, very much, and I hope to see you really soon. So long.